All right. Today is Wednesday, December 14th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. What a day, what a day, what a day it was. But you know what? I'm frustrated, ladies and gentlemen. Why am I frustrated? Because I do this show pretty much every single night, and I pour my heart out for about an hour or so. And by the way, it takes about 4 to 5 hours sometimes to produce the show. But I keep talking over and over and over about the economy, about the market, using the facts and the data. Yet folks continue to be in denial and in delusion, and they can't really figure it out, even though I'm making it as easy as it can be. Speaking slowly, showing the facts slowly, one by one, not rushing to make sure that everybody understands what I'm saying. But my frustration comes from two sides. The usual side is the delusional bulls, of course. We'll deal with them in the In Focus segment, using once again the facts and the data. But the other side that frustrates me is what I call the pussy bears. And by the way, before the ladies get mad at me, this is not an insult to your gender. What do you got against pussies, Maverick? They're strong, they're durable, they pop babies and do other magic tricks. I'm well aware of that. I'm saying as in pussycat. So I gotta be careful here because of the robot police. And since we've been growing our female viewership all the way from the 3 ladies who used to watch the show now to about 6 or 7. So we got to be careful here. But these bears, they're too weak, they're too indecisive, and in reality, they're not really bears, they're just degenerate gamblers. They buy weekly puts, and they expect the market to crash every single week. And today, they were mad at me. Hey, Maverick, you said that Jerome Powell is going to crash the market. The market didn't crash. You're wrong. Unsubscribe. Goodbye. And I say my impression is that a lot of bears are disappointed today, but not this bear you're listening to right now. All I heard is a confirmation from my bearishness and recession outlook. I mean, the only thing that was missing by Jerome Powell is to go ahead and say, hey folks, dump your stock, sell the stock market, short the stock market because we're going down. That was the only thing missing from Jerome Powell today. Does he have to spell it out for you? Every item on my checklist, Jerome Powell covered, and then some. And folks, at the end of the day, it doesn't matter. The inevitable destination is a recession, and the stock market is not going to do pretty good as we head into a recession. The recession will happen either by the Fed doing their job and tightening the monetary policy, or even if they don't do their job, the damage is already done. We're heading into a recession either way. For one thing, I tweeted this and I said I'm sorry to break it out for you, but there's no way the Fed will get inflation down to 2%. Where it should be, by the way, and some would argue that it should be negative because nobody can afford anything right now. To fix this insane inflation and the lack of affordability, inflation has to go down to negative. But anyways, the 2% is not going to happen without crashing the economy and the market. And the sooner you get this through your head, the easier your life will become. And even if the Fed doesn't tighten and they say, okay, we're going to pause, we're going to listen to the crybabies, the economy is heading into a recession either way. Listen to this headline. U.S. consumer loan delinquencies seen surging to 13-year high in 2023. All of this mania, all of this indulgence, we're going to pay the price. And the price is a recession and mass layoffs. And that's going to happen. It's in the bag. You think the stock market is going to do pretty good heading into this disastrous outcome? Of course not. Even Cassandra, the big short, says early 2002, investors were asking me why I was not buying World.com. Feels like that now. Now, you think this guy is hesitant like these pussy bears? Oh, I'm not sure. Maybe we're going to see a short squeeze. Maybe the Fed is going to pump the market. The market is irrational. It's going to do whatever it's going to do. I'm too scared to short. Then you're in the wrong business, buddy. You think this guy is not shorting right now? The big short says you have no idea how short I am. Because he sees what we see here, the inevitable destination of a recession. And there's going to be a lot of damage as that happens to the economy. And as to the desperate, delusional, in denial bulls, I say this, the market is acting like a desperate person who just got dumped by their significant other. She will come back after she realizes that the new guy's bad for her. She's going to call back. Why would she call back when the new guy has a bigger wallet and a bigger schlong? She's not coming back, buddy. Move on. You're in denial. The denial stage always followed by panic once reality sinks in. And today was one of those days. The market is still in denial, And soon enough, we're going to see the panic when they realize they're wrong, they've been wrong, and they're going to be wrong. And this reckoning, this adjustment that has to happen will come with a lot of damage. More on that in the In Focus segment. We're going to dissect every single delusion, every single fallacy by the bulls and the pumpers will be dissected in the In Focus segment. But notice this. Who's pushing the Fed into making the biggest mistake in monetary history? Forget about transitory. Forget about the 1970s. If the Fed stops tightening the monetary policy right now prematurely, this will be the biggest mistake in the Federal Reserve's history. And who's pushing the Fed to do this mistake? The answer is the crybabies on Wall Street, the oligarchs, the billionaires. These are the ones who are crying right now, enough. The Fed is doing enough. They're going to crash the economy. They're going to push us into a recession. Buddy, the recession is going to happen either way. And you're only mad because your portfolio is down. Be honest, you're talking your book, that's all there is. You know that the Fed is doing the right thing right now, and to tackle inflation down, the price is going to be a recession. But you're playing this game to convince the Fed to back off because your portfolio is down. Take, for example, I don't know if you saw this or not, but you got crybaby billionaire Gundlach on CNBC after the bell. He was crying on TV. Yet again, the Fed is making a mistake. The Fed is going to crush the economy. This should be the last interest rate hike. For what? So Gundlach can afford a new $100 million painting so he can sit late at night with his boxers and a glass of wine and jerk off to the painting. A painting, by the way, that my 12-year-old niece could paint the exact same thing. And she will charge Gundlach $50 for that painting, not $100 million. But this is how silly these people are. And then you got another crybaby billionaire in Bill Ackman, who says, oh, the Fed is not going to meet the inflation goal without deep job-destroying recession. See, these snakes did not mind when the Fed was pumping the stock market by stealing from the future of this country and racking up trillions of dollars in debt. They did not mind that at all. But now they're blackmailing the Fed with, oh, you want to see regular folks losing their jobs? Is that what you want, Fed? And it all goes down to they want their portfolios to go higher. And Bill Ackman came out with a long thread basically arguing that the Fed needs to move their inflation target from 2% to perhaps 3 or 4. And I say if the Fed does that, that will be the biggest disaster in monetary policy's history. Because if the Fed anchors inflation at 3 or 4%, inflation will pass that. It will exceed 5 to 6%. That would be the new normal. But again, remember, inflation doesn't impact these snakes at all. It makes them richer. They don't care about that at all. And by the way, a lot of folks say that I'm actually Bill Ackman using voice technology to hide my identity. And for that, I say, Bill Ackman. There you go. And the choice here for Jerome Powell, by the way, notice, the moment Jerome Powell started listening to me, he's seeing positive results on the ground. Inflation went down from 9% to 7%. When he was listening to these Wall Street snakes and the donkey analysts, he made tremendous mistakes, believing that inflation is going to be transitory. So I say that Powell has to stick to the plan, be defiant, and get the job done. He got a choice. Either his legacy is going to be the man who crushed inflation and saved America, aka Paul Volcker 2.0, even though we know that Jerome Powell is the one who started this inflation and he's just cleaning up his mess. But history tends to be a little more forgiving. History remembers the last thing you did, not the one before that. But again, Jerome Powell has the choice of being Volcker or another Arthur Burns, who was a disaster and the architect of the great inflation in the 1970s, because he listened to the Wall Streeters. He listened to the corrupt politicians who said, hey, Fed, take it easy. You don't need to raise interest rates. Who cares about inflation? I mean, inflation impacts the poor, the middle class. Who cares about these bums anyways? Jerome Powell has the choice. Either he's going to listen to these crybaby billionaires who, by the way, wrecked our economy and robbed our country. And there's actually a more appropriate word to use. It's not robbed. It starts with an R, but it has a P before the end. I can't say it because the robot police will go crazy. But you know what word it is. I mean, this country has over $30 trillion in debt. Where do you think that money went? Do you see any new infrastructure, roads, buildings, hospitals, cleaner schools? Perhaps every citizen has free access to health care? Absolutely not. So where did the money go? The money went in wars, in money laundering, to the rich, to the oligarchs. The Fed kept the easy money policy going on, and the government racked up trillions of dollars in debt. And that money got borrowed from the future into the pockets of the hedge funds, the billionaires, the oligarchs. That's where the money went. And they want more and more and more. They want to gobble up everything for themselves. But Jerome Powell has a choice. Are you going to listen to these people, or are you going to listen to the millennial couple who are delaying having a baby because they cannot afford it. They're living in a one-bedroom apartment because they can no longer afford buying a house. But the Wall Street snakes, they're blackmailing the Fed by saying, oh, do you want to see higher unemployment? Do you want to see the poor and the middle class losing their jobs? Look, I did not design this Ponzi scheme economy. I'm just playing by the rules. In a building with 100 residents, let's assume all working class folks, in an inflation like we're having right now, everybody's impacted negatively. Everybody is paying more for rent, for groceries, at the gas pump. But if the Fed fixes this inflation by inducing a recession, 10 to 15 folks in that 100 people building will lose their jobs. And that's not good. But the other 85 will enjoy lower prices and a better standard of living. These are the choices that we have. And these are the choices that Jerome Powell has to make. I mean, look at the Google searches for prices. Be it food prices, house prices, car prices, rent prices, they're skyrocketing. This is an evidence that the poor, the middle class, the working class folks are screaming out loud. We can't take it anymore. You can say that inflation is going down. Baloney. I'm paying more for rent. I'm paying more at the grocery store. I'm paying more for gas. I can no longer afford buying a car. I can no longer afford buying the American dream, buying a house, even though I'm in my 40s. This is what people are saying. The billionaires, all what they're concerned about is, oh, they want to buy a new yacht, so they want their stocks to go higher. Again, the Fed has a choice. Which side are they going to listen to? And folks, if you're new to this program and you thought that this is it, this is all I got, think again. I'm just warming up here, baby. We haven't even started the show yet. And speaking of, here it is, in focus tonight. Higher for longer, which is how I wish my weekends would be. Higher for longer. Stay on the couch, get stoned for longer. A lot of you think of vacation of, oh, let's go to Ibiza and catch herpes. Not this guy. My vacation is staying in the couch, getting stoned, watching some weird crime documentary and pretending that I'm paying attention to. But anyways, before the FOMC came out today, there were 3 fallacies that the bulls were betting on. Fallacy number 1 is that we're already in peak interest rates, meaning this is the peak right here after the 50 and then down we go. Fallacy number 2, which goes hand in hand with fallacy number 1, the market was pricing in interest rate cuts. It's still pricing in interest rate cuts in 2023. Fallacy number 3 is, oh, the Fed at some point will realize that the 2% target is not going to happen and they're going to move it up. And today, Jerome Powell annihilated all 3 fallacies, yet the bulls would not listen. But here are the facts. The expectations by the market, pricing in already, that after the 50, that would be it for rate hikes, and the Fed is going to hold for a little bit, and then down we go. And this was out of touch to begin with. It was already out of line with the pre-FOMC Fed dot plots, which indicated that the terminal rate will be a lot higher, and it's going to come way later, perhaps at the end of 2023. And today came the new dot plots. And guess what? I've been telling you this all along. Even the Fed is underestimating how high rates are going to go. I mean, economics 101. You got an inflation rate of around 7%, and that is the Cook number, by the way. And the federal funds rate at what? You say 4%, 5%? That's going to do the job? Sweetie, it has to go above the CPI to do the job. It's just going to take a little bit for even the Fed to realize that. But they're getting there little by little. For example, the dot plots today moved higher in 2023. The consensus now is that the Fed funds rate will be above 5%. And little by little, they're going to realize it's going to have to be above 6%. We're getting there. Matter of fact, there's a Fed member who sees that interest rates will be above 5% in 2025. And rumor has it, here it is, here's the Fed member who believes that the Fed funds rate will be above 5% by 2025. But you know what? He might be right. If this inflation is going to stay with us for a long time because the tailwinds are pretty much embedded in the economy, we might see the Fed funds rate above 5% by 2025. But here's why the dot plots are significant today. Because prior to the release of the new dot plots, the assumption was by the Fed that rates would be at 4.6% in 2023. Now they moved higher to 5.1%. Their prior assumptions for 2024 were for 3.9% as the interest rate. Now they moved higher to 4.1%. And they also moved higher in 2025 from 2.9% to 3.1%. So immediately that kills the fallacy by the market and the already priced in assumption that this 50 is the last rate hike by the Fed. And we're already at peak rate hikes. The dot plots annihilated this fantasy. Furthermore, for the bulls, the pumpers, and even the pussy bears, their assumption that the market will go higher for whatever reason, fill in the blank, is also a fallacy. You see, financial conditions got looser with the latest rally. And if the market goes higher, for another Santa rally, whatever bullshit rally, financial conditions will get even looser. Look, for example, at the Chicago National Financial Conditions Index. It is ticking down, back to the looser territory. Not even at average, not even close to being tight. And Jerome Powell today made it clear that even with today's hike, they're not at the restrictive rate yet. Financial conditions are not tight enough. In other words, don't rally, you morons, because I'm going to crush your heads again. Take a look.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High-yield credit spreads have come in. The economy has accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many things, of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would point you to the SEP, again, for our current assessment of what that peak level will be.
And by the way, when I say that even the Fed is underestimating how high rates are going to go, notice this. Today, they released the revision for the unemployment rate. And the unemployment rate is moving higher. In the last meeting, they told us, it's going to peak at around 4.1%, 4.2%. Now they moved it higher. Likewise, in the last meeting, they said, the core PCE inflation, that's going down. And by 2023, it's going to be below 3%. Then it goes down to the Fed target of 2% by 2025. Now they're revising this higher. Core PCE inflation will be above 3% in 2023, and it's not going to get to the Fed target of 2% until 2025. And the reporter from the Financial Times did a good job by catching this, and she asked Jerome Powell perhaps the most important question of the day. Take a look.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough, restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today.
So again, Jerome Powell right here saying, I know that the Fed target of above 5% when it comes to interest rates, that's appropriate for now. But if the data changes, we'll move it higher. And she's saying, look, you're already admitting that the core PCE inflation is going to be stickier. And to take it down, even your newest dot plot is wrong. The rate has to go above 6%. And JP came out and said, that could happen. And I know what the bullshitters and the deniers are going to say. But Maverick, this is all before the latest CPI. So the dot plots are wrong. They're not factoring in the newest CPI reading. Well, you're wrong. Take a look.
Thanks, Nick Timmeros of the Wall Street Journal. Chair Powell, I want to follow up on Gina's question. The decision to step down the pace of rate rises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about making decisions meeting by meeting. and being mindful of the lags of policy. Does that mean, all things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint that's still in the pipeline, we think that the appropriate thing to do now is to move to a slower pace. And that will allow us to feel our way and and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size of that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financial conditions.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting.
And by the way, they call this guy the Fed Whisperer, and he doesn't know that the Fed members can revise the dot plots before the release so they can factor in new data. I say forget about Nick Timiraos. The only and the true Fed Whisperer is the maverick of Wall Street, baby. Get that through your head. Now here's fallacy number 2 by the bulls. They're already pricing in interest rate cuts in 2023. Just look at the euro-dollar futures, for example, and today Jerome Powell annihilated this stupidity once and for all. Take a look.
Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
Our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
And here's fallacy number 3. The bulls say, oh, the Fed is just bluffing. At some point, they're going to have to up their inflation target from 2% to 4%, to 5%, to 10%. How about that? And Jerome Powell came out today and annihilated the stupidity once and for all. Take a look.
You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. I wonder, is there ever a point where you actually reevaluate that target and maybe increase your inflation target if it is stickier than even you think it is?
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're going to keep our inflation target at 2%, and we're going to use our tools to get inflation back to 2%.
So here's the bottom line, folks. Jerome Powell confirmed, number 1, the market's assumption of rate cuts in 23, that's not happening. The market's assumption of peak interest rates already in, that's not happening. The rate is going higher and higher and higher. Number 3, services inflation is not abating, and that means more rate hikes. And that actually goes hand in hand with number 2. So the actual number 3 is the Fed is not going to even think right now about upping their inflation target from 2% to 3% to 4% or whatever number you want it to be. Understand this. These people have reputations too. We're talking about Jerome Powell, the Fed. They're also concerned about their legacies. Of course, they're servants to Wall Street and the bankers at the end of the day, but they're also not going to make a rookie mistake right now by upping the inflation target from 2%. They're only going to do that if it gets really, really hard for them. Let's say they get inflation down to 4 or 3%. And we see significant damage in the jobs market. We see a lot of folks losing their jobs. That's the only time when the inflation target is going to move higher. But think about what I just said. They're going to move the inflation target higher if we see significant damage in the economy. Now, you really think that the stock market is going to do pretty good heading into this disastrous outcome? What a load of stupidity, denial, delusion. But at the end of the day, you can no longer deny the facts. This market will be driven by the facts and the data, regardless of the delusion, regardless of the stupidity, regardless of the denial. The panic will happen, and either you're going to realize this right now or you're going to realize it the hard way. And with that, folks, let's move on to cover the stock market information today, and we begin with the closing of the indices, and here we go. The Dow Industrial Average closed in the red, down by 142.29 points, or a decline of 0.42%. The Nasdaq in the red by 85.93 points, or a decline of 0.76%. The S&P is also down by 24.33 points, or a decline of 0.61%. On to the sector's performances today. Notice this: the recession theme is in the lead once again. The outperformers today were led by healthcare, defensives, and utilities. The laggards, led by the risk-on, inflationary/expansionary theme, energy, financials, materials, even technology was down. People say the market is stupid, but is the market really stupid, or are the participants stupid? The market is saying something here, and what the market is saying, hello to the recession. When it comes to the advance to decline ratios, the NYC 57% advancing versus 41% declining. The Nasdaq 52% advancing versus 41% declining. The breadth was pretty good for the day, despite the FOMC, despite all the hawkishness. But remember, we have options expiration on Friday, and we already have bets predetermined, and the market maker is willing and able to induce maximum pain and make all of these calls and puts expire worthless. And then we see the real market reaction next week. Keep that in mind. When it comes to commodities, you say peak inflation, you say it's over, inflation is dead, it's going to crash to 2% just like that, and the Fed has to stop. Look at this. Energy commodities are moving higher. The WTI gained about 2.75% today, so did the Brent. The gasoline RBOB with gains of almost 4%. Heating oil closing the day with gains of over 5.5%. Meanwhile, natural gas with a pullback of over 8% for the day, but mind you, of massive recent gains for natural gas. And of course, we have seen overnight the largest decline in gasoline prices since March 2020. A lot of folks are saying this is a sign for deflation, soft landing. If anything, this is a sign for a recession. But let's play that game. You want to play that game of, oh, this is a sign for soft landing and inflation abating? Look at this. The SPR is already depleted and down in the toilet, and it has to be refilled ASAP. This is a national security issue. Of course, the Joe B administration depleted the SPR to win the elections, the midterm elections, but now it's over. They won. It's over. Mission accomplished. Now what happens next? The Joe B administration is quietly refilling the SPR, meaning they're buying the WTI right now, and that could push prices higher. So we have an economy where the recession force is already creeping in, and perhaps we're going to see energy inflation sticking around for a little longer, and the reason is the government is refilling the SPR, aka stagflation, aka a disastrous outcome. But back to the futures. We have muted reactions for softs across the board, but the notable outlier is sugar futures, which closed the day with massive gains worth about 3%. The dollar was all over the place, and I have a hunch that Tricky Dixie's playing a game here, playing possum. It's going to pop higher again, and therefore we have mixed reactions across metals today. While gold, aka the most reliable indicator for the dollar, was down, silver and copper were up. So who do we believe here? Do we believe gold, silver, or copper? I believe gold. I think gold was muted and cautious today because gold is sniffing a trick here that, oh, the Dixie might be playing dead for now, but it's going to pop higher again. When it comes to meats futures, down across the board, led by lean hogs, down about 1.5% for the day. When it comes to grains, the rally in soybean meal futures continues, adding about 2% worth of gains today. Yet we have a pullback in soybean oil, down about 1%. Besides that, we have muted reactions across the board. On to the big casino, the options market. What's going on here? The hottest table remains Tesla, the souffle, with around 2.3 million contracts traded today. And look at this, boy. About 65% of the volume were for puts, not calls. Now, a lot of folks look at this as a contrarian indicator that, hey, a lot of folks are now Johnny-come-latelys buying puts in Tesla, and that means that Tesla could pop higher. It needs a catalyst, folks. It needs a new CEO. That will induce a lot of short covering. But look at the IV rank at around 48.5. That's not high enough for the put to options ratio to be a contrarian indicator. If the IV rank was at around 90 or 100, then we're talking. But for now, there's plenty of room to the downside to go for TSLA. And at number 2, Amazon with around 1.2 million contracts traded today. Look at this, around 66.5% of those were puts. And at number 3, Apple with around 930,000 contracts traded today. Once again, puts outweighing calls by about 53%. Now, when we look at the unusual activities that took place in the options market today, we don't have a lot of them, but we have the IWM, and somebody's buying calls here, betting for perhaps a Santa Claus rally, and they bought the 190 calls for the expiration date January 27, with expectations that the IWM could move higher and add gains worth about 6% or more by the expiration date. They paid around $2.20 a piece to enter this trade, all in all spending around $3.5 million. And lastly, at the bottom of the table, what about the ticker DIA? Now, this is for the Dow Jones, which has been the outperformer as of late, but somebody sees declines to come for the Dow Jones. And in this case, they bought the 315 puts for the expiration date February 17th, with expectations that the Dow Jones could lose more than 7% of its value by then. They paid around $3.5 a piece to enter this trade, all in all spending around $1 million. And then what about the heat map? What's going on here? Red across the board with exception of the recession theme, in which we talked about this ad nauseum before. Healthcare, utilities, packaged food, fast food, tobacco, alcohol. These are the kind of names you want to be in. And guess what? The big pharma names in the green today, led by Pfizer. No problem here for Pfizer. Fed, no Fed, J-Pal, no J-Pal, who cares? Pfizer goes higher anyways. All of that money laundering cash, well, it's showing up. And then you got the packaged food, you got names such as Kellogg's, General Mills, all outperforming, but we'd like to see more. They did not outperform by a lot, and neither did utilities. So we have to wait and see if these sectors are going to start to catch a bit from this point on. But again, it's really important to look at the reactions for real estate, for example, including Blackstone and financials, BX, which was down big. Even though rates were down. What does that say? I thought when the 10-year goes down, this is supposed to be good for real estate, good for Blackstone. And indeed, in the past, when rates went down, Blackstone went higher. When rates kept moving higher, since the beginning of the year, it made it a painful year for BX, but now we're seeing the opposite reaction. Rates go down along with BX. I mean, isn't this the recession theme manifesting right before our eyes? Could be. Now, of course, the notable underperformer has been Tesla. Tesla has been getting crushed, an ugly week for TSLA, and has been ugly for a while now. And unfortunately for Tesla shareholders, Reverend Elon Musk continues to make major mistakes, one after the other. You see, he already alienated the hedge funds, the BlackRocks of the world, the deep staters, the other oligarchs. They're all anti-Elon right now because he took over their propaganda tool and promised to bring free speech. And he gained the support of a lot of people, regular folks, including me, even though I've been a critic of Elon Musk. But I said, okay, let's walk the walk. Let's give this guy a chance, What does he do? His ego gets a little bruised by this kid who has the Elon Jet account that tracks Elon Musk's private jet. And of course, Elon has been butthurt about this for a long time. Not because of a security reason, as he claims, but because it exposes his hypocrisy. On one hand, he claims that he's building all of these soufflés because he cares about civilization and the planet. But on the other hand, he's using private jets to go to 7-Eleven, and he got exposed. And he doesn't like that. So what does he do? He decided to ban the kid, to ban the Elon Jet account. Okay, you're going to lose support from people like me because you're not delivering on your promises. You're no different from the people you just took over Twitter from. The deep staters, they censored whatever they didn't like, whatever bruised their egos. Now we have an oligarch in Elon Musk who's also suspending and censoring what he doesn't like. Anything that challenges his ego, he's going to ban. Well, this is not free speech, Elon. And of course, he continues to dump Tesla shares. We're going to find that out, by the way, in details in the next filing. But he continues to dump Tesla shares because he's running out of cash in Twitter. Twitter has no revenue at all, but a mountain of expenses. And even after the layoffs, that didn't fix it. So now Elon is auctioning off the furniture, the fridge, all the appliances in Twitter HQ, and he's not paying rent. He's giving the mid-finger to the landlord. He's not paying the rent. No thanks. Now, think about this. Can you go to your landlord and say, you know what? I'm not paying the rent. Well, your ass is going to get evicted right away, but not the billionaire. He can pull such a move and hire lawyers and fight it off just to protect his ego, of course. But anyways, moving on to the heat map for the ETFs right across the board. But here's the notable take. XLP, XLU, XLV outperforming, aka the recession theme. That's number one. Number two, the VIX proxies are underperforming. UVXY, VIXY all down. And by the way, the UVXY is a scam. Now, I've been cautioning traders not to use it. I've made the mistake in the past of buying calls in the UVXY, waiting for the VIX to pop, and I always lost money. The best way to do it is to buy puts on the SPY. If you're betting that the VIX is going to pop, you buy puts on the SPY. But anyhow, that leads us to the mystery of the VIX. Why was the VIX down? We'll talk about that in the charts analysis, but before we do that, anything else interesting here? Not really. In the international ETFs, the Chinese ETFs bounced a little higher, but again, they're going to go down. The FXI, the MCHI, they're not going to hold here. Just let the reopening fantasy, or fallacy we should say, sink in, and then we see the FXI going down. On to charts, and we begin with SPY, the S&P 500 30 minutes chart. And again, we talked about a bear flag pattern. So despite the pop that we got in the morning, it got us all the way to 405. Couldn't make it. That was stiff resistance. What do you know? After the FOMC came out, here comes the flush down all the way to the next support at around 398. So all in all, the SPY was down. Yet the pussy bears are complaining. You said the market is going to go down. It went higher. Are you looking at the charts or not? And it could get a lot uglier here for the SPY if it loses 398 as support. When we look at the continuous contract for the S&P 500, the daily chart, again, nothing happened today. It remains within range with the support of 3,960 and the resistance at around 4,100. Yet the negative divergence on the RSI persists, and then we have the MACD indicator also showing negative momentum. None of that was fixed at all. Not by the post-CPI pop, and not by the rally today that I seem to have missed, right? The bears are telling me, but the stock market rallied today, Maverick. What are you talking about? What chart are you looking at? Here's the weekly chart for the SPX, the cash index for the S&P 500, and again, it gave it a little poke above the sloping line of resistance, but it is pulling back. And if it breaks the support, as you can see in the line in yellow, by the end of the week, it's game over. It's done. We're going to make a lower low. We're going down to 3,270. So whatever stupidity the market wants to pull, it better pulls it right now. The NASDAQ, the Qs, 30 minutes chart, what's going on here? Again, a bear flag. The bear flag played out. We lost the support of 290. We lost the support of the top of the breakdown candle. And we lost almost 284.26. So all in all, the Qs was down. And the way the chart's looking right now, it could be more damage to come. A closing below 284.26 will seal the deal. And here's the daily chart for the continuous contract for the NASDAQ. Nothing changed today. Within range, the support 11,689 and the resistance at 12,207. You break one or the other, then we have a deal. You break above 12,207, the bulls win. We have a Santa Claus rally. You break below 11,689, no Santa rally, and down we go all the way back to the June bottom. And for now, the RSI still in negative divergence. The MACD still showing negative momentum, although a little tick today. Little tick. So we'll see what happens. When it comes to the IWM, the 30 minutes chart, again, the bear flag did play out. The chart could not make it above 183, but it moved down to the next support, which happens to be a support gap, or a gap support, excuse me, and the chart stopped short of breaking the support. But if it does tomorrow, we go down to 174.22. Here's the dollar index, the daily chart. Again, you look at the RSI, you look at the MACD, it's just a matter of time for it to pop. And today was the ideal opportunity for the dollar to pop, but it chose not to. So either number one, the dollar is playing possum, and it's going to pop right after the fact, or are we seeing the beginning of the recession theme in which the dollar goes down along with stocks? Yields go down along with stocks. That could be a dangerous development. I'm not ready to make a call right now. I have to see more from the dollar. I have to see how it's going to react all the way to the end of the week. But here's the most reliable indicator for the dollar, gold. Here's the daily chart. If the Dixie's down, the assumption is gold should have popped higher. It didn't. Gold continues to consolidate here as if gold is saying, I'm not sure if the dollar is indeed going down. I gotta wait and see. So you know what we're gonna do here? We're gonna wait and see. How about the weekly chart for Brent oil, aka UK oil? Look at the negative divergence in the RSI. That's about to be broken, meaning we're about to see a rally in oil if this holds. The MACD is firming up a little bit. It appears that the support of 77 is holding up at least for now. And folks, I have a gut feeling that before oil goes down for good, there is another massive rally to come. And this rally, despite what the trigger is, could scramble all of these assumptions by the bulls and the pumpers that inflation has indeed peaked and is going down. And that could be the moment when they're going to realize that they're not going to have a happy ending here. Not in the economy and not in the market either. How about the 10-year yield? Here's a daily chart. Didn't do anything at all. Still consolidating at around 3.5. But again, the RSI is oversold along with the MACD indicators. And what they're pointing out to here is we have another pop in the 10-year coming. Is it going to happen today, tomorrow, by the end of the week, next week? I don't know. But I don't think the 10-year is going to give up 3.5 as support easily. So again, we might see a delayed reaction here in which the dollar and the 10-year they will pop higher, but perhaps not right away. Perhaps by next week. Maybe after all of this options expiration manipulation is already done and behind. And here's the daily chart for the TLT. Flattish for the day, nothing changed. But I continue to say if you made gains in the TLT in the recent pop, why not take some profits off the table here, wait for a pullback, and then hop in again. And here it is, the mystery of the VIX. The 4 hours chart, the VIX went down. It lost about 6% today in a day when Jerome Powell came out extra hawkish. So what's going on here? Again, options expiration, that could be the catalyst here for the VIX going down. But we're not through yet with the outlook that this could be an ABC pattern and the VIX could pop higher again. That goes out of the window if the VIX loses 20 as support once again. But remember this, before the FOMC, there were a lot of bearish bets betting that the Fed will do 75 instead of 50. There were a lot of extreme bets that by the end of the week, the SPY is going to be at whatever number, down 5%, down 10%. As the conference was ongoing, a lot of these folks realized that this is not going to happen, and they scrambled to close these shorts right away, and that caused a lot of volatility in the VIX. When folks closed their put options on the SPY, that's going to push the VIX down. So if you're assuming that the VIX went down, and this is a good indicator that we have a rally coming, be careful here. This could be a delayed reaction. This could be a knee-jerk reaction for now. And then we see the real reaction happening by tomorrow, by the end of the week, next week. So you got to be careful here. Here's Apple, 30 minutes chart. Again, consolidating the bear flag, and the bear flag played out. And guess what? Apple broke the trend of higher lows. This is not a good development. It lost 145. So you can say whatever you want about, oh, this was good for the bulls. I don't see it that way. Apple lost 145. It lost the pattern of higher lows. It means that Apple is heading all the way down to 138.79. Despite any rebound to come, the damage has been already done. Tesla, 30 minutes chart. We talked about the head and shoulder formation. We talked about the reverse ABC pattern, and it appears that it is playing out, and down we go to the target that I talked about last night. But again, I believe that at some point you're going to get the news that Elon Musk has been dumping shares. And now, would that be a catalyst for a short covering rally? When folks say, okay, Elon Musk is done dumping for what, the 10th time now? When he promises, okay, this is the last round of dumping, and we're done. Or will the market say, bullshit, Elon, you've been dumping and you're going to dump more because you got a lot of problems going on in Twitter. And therefore, that could be a catalyst for more declines to come. We'll see what happens. And lastly, Bitcoin. The bull flag played out, and it got us all the way to the resistance at around 18,000, and it couldn't make it and close above that number. Is it over? Does this mean a reversal? Of course not. We have to wait for the confirmation. If we have another down candle that erases the entirety of the gains from the last two candles, then we have a reversal, and then we can say comfortably that Bitcoin is going down to 15,000. Absent of that, for now, Bitcoin bulls remain in charge, and they might take 18,000 if they have the momentum by tomorrow. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the initial jobless claims on top of the retail sales. We also have the Empire and the Philly Fed manufacturing indices, along with the capacity utilization rate. All of these are good indicators for inflation and what's going to happen in 2023. And with that, folks, it's been a long day, so this is all I got for you for now. Once again, thank you for listening, thank you for watching, and I will talk to you again tomorrow.
Rose, I am not in denial.
Oh, yes, you are. You're just denying you're in denial.
Rose, I am not denying that I am in denial.
If you're not denying you're in denial, then you're in denial.
Oh, I wish that it would never